Welcome to our training today. Today, we're talking about how you can use consistent revenue in your business to qualify for financing. This is some of the fastest and easiest types of financing that's available today based on your revenue. We're going to dive in, decode it. By the end of this, you're going to understand what revenue financing is, how it works, and most importantly, how you can tap into it to get money for your business. If we can help you along the way with getting money, our phone number, our email will be on the beginning and end of our slides. And at the bottom, you'll be able to find our direct link at creditsuite.com/get funding, or just give us a ring for a free business credit funding consultation at 877-600-2487. So let's dive in and talk more. So here's the thing. When it comes to revenue in your business, if you have predictable revenue, then it's a great way to leverage to actually get financing. So in a lot of cases, business revenue kind of goes up and it goes down. But in a lot of other cases, your revenue is somewhat consistent. It stays pretty stable, or it consistently increases in time. Okay. Now, consistent revenue, obviously very important. So you can pay payroll, so you can cover all the expenses that you know you have to cover. But there's a kind of financing, if you do have consistent, stable revenue, called revenue financing. It also is called royalty-based financing. It's also called cash flow financing. Merchant cash advances are a version of this. A lot of different names it goes by. But it's basically a way to get money using your future revenue, selling your future revenue at a discounted rate to actually get financing. So in a revenue-based financing investment, investors are basically getting a regular share of business income until a predetermined time frame. And that's how it works, is that with revenue lending, you're basically issuing part of your future revenue to the investor. They're taking that. So they deduct money daily, weekly, or monthly from your bank account to cover their payment. Now, a lot of things that are nice about this, including, as we'll talk about, some flexibility. If your revenue goes down, those payments can go down. If your revenue goes up, then your payments can go up. So it depends on a lot of those variables. And Truckin' Fascio says hello from YouTube. Thanks for tuning in. I appreciate that. And thanks for all you do in the transportation industry. So you can usually get they're usually getting about 3 to 5 times the amount of the original investment. Typically, we'll talk about this. Interest rates wildly vary on this. We've received an interest rate of 8% with this kind of financing. I've seen interest rates as high as 4 or not really interest, but I've seen people pay as much as 40, 50%. So it fluctuates depending on risk. So how does this work? Well, the business must make regular payments to pay down the investor's principal. Basically, the bank, the investor, the lender that's coming in, you're basically making payments to them consistently through automatic withdrawal, daily, weekly, or monthly. Okay. This method of financing is different from regular debt financing. For one thing, interest is not being paid on an outstanding balance. Another is that there's no fixed payments. So payments to the actual investor or the finance source really come down to how your business is doing. So this is one of the nice things about revenue financing. With a typical debt financing loan, when you go get a loan from a bank or lending institution, a fintech lender, then what happens with that loan is that you have a set payment. So if I go and get an SBA loan, my payment is $5,000 a month. I have to pay $5,000 a month. Even in times of COVID where my revenue may be down, then I still have to pay $5,000 a month. And this becomes problematic because in a cyclical economy where, the economy goes up, the economy goes down, your sales might go up and down. Well, then the problem with a normal loan that you have to pay back a set payment on is that if your sales are down, you still have to make that same payment. With revenue financing, they're taking back a percentage of their payment through whatever money you're generating that month. So it might be 3 to 5% of what you're generating that month. So if your sales go down, they make less money. If your sales go up, they make more money. But that way, your payment is flexible depending on how the revenue in your business is actually working at any given time. Now, it's definitely different from equity financing as well, because with equity financing, you're giving up an ownership stake in your business. And that's not this. If you're doing angel investing, venture capital, you're giving up ownership interest in your business to get the money. You don't have to do that with revenue financing. So it's a little different than normal debt financing. You are taking on debt, but you don't have a fixed payment. And it's very different than equity financing because you're not giving up equity in your business to actually get approved. So in some ways, it's kind of like account receivable financing, because with AR financing, the company basically is using receivables to get financing. They're basically, if you look at the difference between, or the comparison here, with account receivable financing, your customers pay you on terms. Well, instead of waiting weeks or months to get paid, you can get that money advanced to you in 24 hours. And the way that that works is that you're actually selling your future receivables for a discounted rate. That's the exact terminology of how AR financing works. This is similar where you're selling future revenue at a discounted rate. So that's ultimately what you're doing. They're not even really paying an interest rate. You're paying what's called a discounted, or you're paying what's called a factoring rate, because ultimately you're selling future revenue for a discounted rate. Okay, so that's how that's kind of similar to AR financing, is that both of these, one with AR financing, you're selling future receivables. With revenue financing, you're selling future revenue in order to basically use that future revenue as collateral to get financing. And Truck and Fashion says, a friend of mine saved this business with this kind of financing, 10K daily automatic withdrawals for payments. Yes, that's a lot of money he got. And this is a good point that you bring up. Look, this is a fantastic kind of financing to get money quickly and easily, even if you have credit issues. But the problem is that it can be expensive if the risk is high. And sometimes they're deducting money daily, so you have to have money in the accounts for them to take. Now, 10,000 daily auto withdrawal is a lot of money. If you think about that, that's $200,000 a month is he's paying back. So since that's usually financed over 1 to 5 years, that means he probably got payments, even maybe loans in the millions to get that kind of financing. But it gives you an idea of how this kind of financing works. So because repayment of the loan is based on revenues, then the time it takes to repay the loan is going to fluctuate depending on what kind of revenue you have, right? The faster your revenue grows, the quicker you're going to pay off the financing. The smaller the revenue grows or lose revenue growth, well, then it could take longer. The percentage of monthly revenues committed to repayment can be as high as 10%, typically not. So you're dedicating anywhere from 3 to 10% of your future revenue to actually pay back the financing. And as I mentioned, monthly payments or daily or weekly payments are going to fluctuate based on the actual revenue you have. Now, the duration of the loan ultimately depends on the success of the business, but in a lot of cases, they do have kind of set terms of what they're going to pay. A lot of revenue financing today is based on a year, 2 years, 3 years, 4 years, 5 years. Some of it's still as flexible as this, where your revenue goes down or up, your payments will change, and the time frame isn't set. But with a lot of revenue financing nowadays, they're looking historically at what you've done, they're estimating what you may do, and they're giving you a term of anywhere between 1 to 5 years to actually pay back the financing. It's more set than some of the other older kind of revenue financing, where it was a little bit more flexible and the term could vary based on your actual revenue. Now, providers will expect you to have a plan to increase your business revenue. Okay, as part of the application process, they may even ask you that. Okay, but they're going to want to see what your current revenue is, and they're going to basically look to make sure it's stable or increasing. Preferably for revenue financing, you're getting money strictly based on revenue. So keep in mind, I talk about this all the time, 3 C's of lending: cash flow, credit, and collateral, right? So if you look at it, this is based on cash flow, which means your credit can be bad, your collateral can be bad, and you're still able to get approved based strictly on having consistent cash flow for your business. So if that is your asset, then there's a very good chance you can get approved. But during the application process, they're going to want to look at 6 months bank statements. They're going to want to make sure that your revenue is consistently stable or increasing every single month, okay? So what they're really planning on is that your revenue is going to be basically enough to pay for the actual debt and pay the debt payments that needs to be paid back. Of course, any kind of money you get is the same way. They're really looking more than anything else at your ability to pay back that money. Now, business revenue financing is perfect for entrepreneurs looking for very fast, easy money. And here's why. You can get approved for as much as $500,000. Sounds like a lot, right? So typically it's 10 to 12% of whatever your annual revenue is. So if your annual revenue is $200,000, for example, you're typically going to get 10 to 12% of that, which is like whatever that is, $20,000 to $27,000 you're going to get lent to you. If your company revenue is $1 million a year, you're going to get 10 to 12% of that, which could be $100,000 to $112,000 roughly. So that 10 to 12% of whatever your annual revenue is pretty standard of how much you're actually going to get. Up to $500,000 is common, but you can get approved and fund in less than 3 days, in 72 hours. I've seen people get funding with this program 24 hours and 1 day get funding. So it's very fast. It's the fastest kind of funding that I've seen in today's lending industry, in lending landscape. Okay, other kind of financing like account receivable financing, you can get funded in 24 hours after a 2 to 3 week initial underwriting process. With this, there is no 2 to 3 week initial underwriting process. In 2 to 3 days, you can get the whole thing done and money actually based in your bank account, or put in your bank account. And again, they're going to typically look at your merchant account statements, and 6 months worth of bank statements is what they actually want to see. Okay, so again, completely based on cash flow. So because cash flow is the C we're using, You don't need any kind of collateral to qualify, and you can get approved with even very subpar credit. Now, your personal credit will determine the risk. Like I said, I've got this with a very low interest rate, 8%, but my credit was really good. Our revenue was stable. There was a lot of things that made us get the lower interest rate. So you can get approved, and the rate you're going to pay is going to be based on risk. If you have bad credit, you could still get approved as low as about a 500 FICO score. But again, the problem is that you're going to pay a higher interest rate. So keep that in mind. You're going to pay more money and a higher rate if your credit's bad, the same as if any of your risk factors are high. So the nice thing about this is that it works really well with Main Street type businesses. Venture capital, angel investing. You're not going to use a lot of that stuff for a standard type of industry like a bar, a restaurant, a retail shop. Angel investing, venture capital, it's more for very unique business concepts. This works for everybody. Okay, it works for all kinds of industries, even high-risk industries, and it's very popular, if not the most popular type of funding that's used for Main Street businesses, like typical retail locations. A lot of different type of companies use it, but Main Street businesses really use this more than any other kind of financing. Now, in order to qualify, you're going to need to have solid, consistent revenue, as we talked about. The revenue needs to be consistent. They would like to see growth potential, like seeing your revenues actually increasing as well. Okay, and you still retain control. Remember, you're not giving up any equity in the business for this kind of financing, so you're still able to stay in control. You're just selling your future revenues at a discounted rate is what's actually being used for leverage. Now, we work with a lot of different lenders that can actually help you with this, and it depends on your unique situation because everybody is a little bit different based on your risk, your credit score, how long you've been in business, your industry. For example, we've got specialized financing sources that just work for people in the pot industry. Okay, so if you're a dispensary or you're anywhere in that sector, there's specialized funding just for you in that niche. So there's a lot of niche funding out there depending on your industry that we work with. There's literally thousands of different lenders around the country that do this kind of financing. So how do you qualify? Well, typically they're going to want about 6 months worth of bank statements to look at what your revenue is. They're going to look at what your annual revenue is every month. They're going to want you to have at least $120,000 in annual revenue typically. Some exceptions here are PayPal, are Stripe, are Square. They'll typically help you if you're just a few months into business. But most sources here want you to be in business 12 months. Most want you to have $120,000 in revenue. Like I said, exceptions like PayPal, Square, those guys will give it to you even if you're a few months in business and you don't need $120,000 in revenue. But keep in mind, a lot of the other fintech lenders are going to want you to have about $120,000. They're going to look and make sure that you are preferably growing month after month. They are going to look that you don't have a bunch of non-sufficient funds at the on your bank statements every month. Think of it like this. They are deducting money daily, monthly, or weekly from your bank account to get paid. If you have a bunch of non-sufficient funds, that shows you don't even have enough money in your bank account now to cover your existing bills. So how are you supposed to pay the new loan if you can't even pay your current bills? That's how they look at non-sufficient funds. They want to see that you have consistent deposits and not a few of them. They want to see you have 8 or more deposits a month. The more deposits, the better. They like, for example, restaurants where you have deposits every day, businesses where you have deposits every day. They don't like real estate agents that have 1, 2, or maybe 3 deposits in a month because, if you don't get one of those deposits, well, then you might not have enough money to pay them back. So they really like that you have consistent deposits throughout a month, that you have positive cash flow, more money going in your bank account than coming out, that you have a positive ending bank balance at the end of every month. When I look at those bank statements, I don't want to see that you're negative at the end of every month. It needs to be positive. It needs to have little to no non-sufficient funds. You can still get approved, 5, 6, 7, 8, you can still get approved, but it becomes harder and your risk becomes higher because, again, if you don't even have enough money to pay back what is due right now coming out of your bank account, how are you supposed to service the debt on this? That's the way the finance source is going to look at it, right? Okay, so it's not perfect for a lot of business owners, and let me kind of get into that as well, because it is really good for you if you have credit issues. But one of my friends, actually a friend of mine that was a teacher of mine in high school, came and I saw something on Facebook. He said, "I need some money, and I reached out to him. I said, "Hey man, I'm in that space. Maybe I can help you." He told me a situation. This seemed like something he'd qualify for, but when he told me what he needed the money for, it was because he was in a seasonal business. His sales were down. So he needed money to get him through till when his sales went back up. I told him about this program and said, you need to know this is not the kind of program that will work for you. You could qualify, yes, but it's not designed for people to carry them through slow times. It's more designed for people that are going to get the money and use it to invest in something that will make them more money. Okay, so meaning this isn't the cheapest kind of money that's out there. If we look at all the kind of funding options that I talk about, this is one of the more expensive ones that are out there. You don't go get expensive money to pull you through slow times. You don't go get expensive money just to have it laying around in case you need it. You go get expensive money when you know you're going to invest into something that you know can give you a greater rate of return on the end. So let me give you an example. One of our clients makes energy drinks, and he has all the packaging done somewhere else. Well, if he got the packaging and could do it in-house, it could raise his margins by like 60%. Like, it was an exorbitant amount of money. His credit was bad. His risk was high, but it still made sense for him to pay the high payments and high interest to be able to get the money to bring the bottling in-house, because when he brought the bottling in-house, within 90 days, he radically improved his revenues and his profits. So that's a perfect example of somebody that's using money to do something to get something that will grow the business. I'll give you an example in our world. The first revenue financing loan we ever got, we got specifically because we were hiring somebody for business development. We were opening a new office to house our sales team, and we were doing some more expansion. So the bottom line is we use the money to then hire business development and then to bring in these new sales team members to start taking on these new lead sources. So we immediately used the money to grow the business. Business development made us more revenue. The sales team and the new lead sources made us more revenue. And we used the additional revenue to pay the actual debt that we got through revenue financing. Perfect examples of how revenue financing should be used. The interest is 100% tax deductible. So even if you pay the 8% we've paid or the 50% other people pay, it doesn't really matter if you write off all the interest anyways. What matters is that you can afford the payments and that you're going to get a way better rate of return on what you're going to invest the money into than what you're actually going to pay on the money that you get. Okay, perfect example. And I've seen somebody pay as high as 65% interest on a funding product, but the guy was buying a tree destumper for a golf course. Like, he destumped golf courses, and he had to have like 5 people do the manual labor or a machine do it. And he saved $10,000 a month, even with the higher payment, because it was cheaper for him to buy the machine and use it to get him to do that job than the actual people. These are good examples of people that can even pay higher interest, but it still makes sense because you're investing the money into growth in your business, and the growth is considerably more than what you're actually paying for the actual debt servicing or to pay the loan back. So you can even be approved, as I mentioned, with severely damaged credit, recent derogatory items, bankruptcies, collections, late pays, any of that kind of stuff. You're still able to get approved. It's the number one. I can't say that. It's one of the best programs out there for credit issues. The best programs still are ones where you have collateral. Because if you have assets that are serving as collateral, then that's still the best kind of financing to get if you have credit issues. But this is really one of the best types of ways to get money if you have credit issues. As I mentioned, you can usually get pre-approved same day and fund within 24 hours. Almost always the money is in your bank account in a week or less. And again, in almost all cases I've seen, you're getting the funding in 72 hours or less. 6 months bank statements is typically what they're looking for. About 8 out of 10 of our clients come back and get more. So the way this financing works is that if you get your first advance, your rates are going to be a little bit higher, because then you need to prove yourself. Once you've paid back 50% of the money you owe, then the finance source is going to come back to you and they're going to say, hey, do you want more money? And if you want more money, they're going to give you a longer term and a lower rate. So like, it's not a lot of money increase to your payment to get a lot more money in funding. Okay. And this happens when you pay off about half of the advance. About 80% of our clients come back and they love it so much they get more funding. And when you come back for a second round of funding, they typically only see 1 or 2 bank statements. It's very simple. And that's when you usually can get funded within 24 hours. So this is really cool because you get it once, you're used to paying it, then you pay down half of it, then you have a chance for a bunch more money when your payments don't go up a lot more. Okay. And very simple, in a day with 2 months bank statements supplied, you're able to get approved. So it makes it really easy in the future when you need money to tap into this funding and get even more. Now, again, once you've done it, it's really quick and easy to be able to do more. You can get approved for as much as $500,000 typically. Okay. And as I mentioned, you can get funded really quick with this as well. There's no application fees. There's no collateral. You can get it with bad credit. You can get approved for about 12% of your annual revenue. Some sources even offer credit lines with this as well. Some other sources, you don't even have to supply bank statements. They use artificial intelligence. So all you need to do is just supply your bank account login credentials to the funding source. Their computers automatically go log in and do the underwriting. And with those sources, you can fund same day you can get your money. So a lot of different options here. Artificial intelligence, where they do it electronically, different lenders based on different industry and based on different risks that you can go through. Some offer loans, some offer credit lines. Some take money daily from your bank account for payment. Some take money weekly or monthly from your bank account for payment. So a lot of different options. This is why our numbers on the bottom of the slide, give us a call. If you give us a call, 877-600-2487, we can look into your bank statements and we'll give you an idea. Here's how much money you could potentially get. We can get you a pre-approval same day typically to give you an idea of how much money you can get with no hard inquiry on your credit report. You can find out how much money you're able to qualify for. Then if you want to get funding within 72 hours or less, you typically can. And we worked over 1,000 funding sources. So we're able to help find the right source for you based on your risk and based on your industry. So this is not really a loan. It's basically selling future revenue at a discounted rate, but it's very easy way to get money. Very fast, very easy way to get money. You don't need collateral. You don't need good credit to get approved. You don't need to give up equity interest in your business either. It's one of the easiest ways to get money for your business if you have consistent revenue in your business. Now, if you're interested in talking more about this kind of funding or just getting approved for the most amount of money for your business, give us a ring. Okay, because we help you get money. We never charge you fees. Okay, lenders will charge you fees. We negotiate with them to get you the lower fees. We do so much volume. We use the volume that we do to get you a discount, so you even pay the lender less fees than you pay on your own. We'll help get you the blueprint, the roadmap to get into SBA or to get into SBA loans as well. Our goal is that you never need to look for funding again. You can get in touch with us whenever you need money, and we're going to help you get the money you need. 877-600-2487. Free consultation with you to talk to you about building business credit. We'll help you get your business credit reports for free. We'll do a funding assessment to see how fundable your business is. And we'll tell you all the money you can qualify for now with loans and credit lines. And all that happens at no cost with us for a consultation. If you look at our reviews, you'll see people love getting on the phone with our team because of the knowledge that they end up walking away with. And if you liked this, then tune in Tuesday and Thursday at 1 Eastern and 11 o'clock Wednesday at Eastern time, where we go live with training like this that teaches you how to get business credit financing and grow your business, improve your fundability. We have hundreds of training videos on our YouTube channel, daily tips on Twitter and Instagram, a podcast you can listen on the go, and all of them are available at creditsuite.com at the top right of our page. If you got value from this, do me a favor, punch that like and subscribe button. And when you subscribe, select to get notified when we release new content. And you'll be able to get information just like this that teaches you everything you need to know to get money for your business. And if you'd like to find out how much you can qualify for right now, give us a ring. 877-600-2487. That's 877-600-2487. And Kalinan from YouTube says, great, makes sense. I'm glad you like it. And Chanel, which by the way, Chanel Flowers, Chanel, my daughter's name is Chanel, so I love your name spelled a little bit different. So, hey, thanks for tuning in from Facebook. And EA, I can't even pronounce that, from YouTube, is this good for acquisition financing? It very well could be used for acquisition financing. The best kind of funding for acquisitions is SBA because you can get long-term, low-interest rate financing using an asset like account receivables of the business you're looking to acquire. But we use this a lot to help companies acquire businesses because you're using the revenue of the business to actually qualify to get money to buy out the owner and be able to get funding. But the term is short. So it's only going to work if you're going to acquire a business and you know what you're going to do to really get that business to generate more revenue. Remember, this isn't the kind of financing you get just to get. You typically get it when you're going to make a move to grow the revenue in the business. So if you're acquiring a business and you know you're going to be able to do some things to drive the revenue up pretty quick, great kind of financing for that. If you don't know if you're going to be able to drive the revenue quick in the acquisition, there's other funding that can work better for you, including SBA. Give us a call and we'll talk to you more about that. Okay. And Chanel says, great minds. I agree, Chanel. I love that. Okay. So thanks everybody for tuning in. I hope you have a great day. I'll be back here on YouTube at Thursday at 1 o'clock Eastern to talk about more cool ways to get money for your business. Make sure you tune in. Make sure you like and subscribe. Thanks everybody. Have a great day.